Ann Walsh is the CIO of Guggenheim Investments. She's here with us right now to kind of break all of this down. I know you've been sitting here listening to a lot of the stuff that's been going on, from Secretary of Energy Chris Wright and his comments with Brian to what's been happening with these defense contractors, all in the context of a market that is at or near record highs. As a CIO, is it at all confusing kind of where the markets are at right now? And if so, why or why not?
So thanks for having me. Happy New Year. I spent a lot of 2025 thinking about the Trump administration and their policies, particularly as regards the U.S. Economics, whether it was tax, tariffs, deregulation, immigration. I think for 2026, we probably have to add another one of those policy pillars for the Trump administration, and this time it's going to be geopolitical. And we started off the year, obviously, with the police action in Venezuela with the removal of Maduro. We're obviously talking a bit around the edges right now about Greenland. And of course, we're coming up on USMCA renegotiation. All of this is going to be writ large as we go through 2026. And so I think one of the themes for the year can be expect the unexpected from this administration.
What's interesting about the unexpected part, geopolitics is always somewhat unexpected. But over the course of the last couple of decades, at least right now, many of those geopolitical risks that have been at least in play as catalysts potentially for downside market moves have oftentimes been short-lived. They've been in a situation where we say this could be a flare-up. It could be in the Middle East. I remember the Qasem Soleimani and the assassination there. We thought that might, kick off a whole round of real unrest in the Middle East that never really, truly came to fruition. So if we are in that mode right now, just how much do geopolitics worry the markets that are at or near record highs again?
So geopolitical headlines tend to be market moving in very short periods of time, as you just mentioned. But they tend to get priced in, and then the markets go back to watching the things that are more drivers of price action. For example, profits, margins, valuation, and other metrics. And so what ends up happening is the buy the dip mentality returns, and these very limited opportunities exist to reposition portfolios. I think in these circumstances, you ask about what positions we would take in this circumstance, and that would be diversification. Risk mitigation, when you're talking about a lot of headline moving elements, and that could be everything from the elements we've already talked about, but also this week we could get the trade and tariff decision from the Supreme Court. That's definitely going to be impactful, I think, one way or the other. So I think that being diversified and being ready is probably the best insurance, if you will, in terms of protecting portfolios and also being able to take advantage of opportunities.
That Supreme Court ruling is a biggie. I mean, it could affect GDP. It's going to be a big one way or the other. So do you guys kind of gaming that out?
Well, the market right now is expecting about a 30% chance that the Trump administration prevails and that the tariffs will remain in place. So the contrarian,
a 70% chance that they don't. Exactly.
The contrarian view is the 70% chance that the decision goes in favor of the Trump administration. Mm-hmm. And so what we're doing in expectation is as I think most investors, I mentioned diversification. We are prepared for some volatility around the result. And again, the contrarian view is the Trump administration prevails and that the tariffs remain in place.